Okay, let's get started. Good afternoon. My name is Brian Sikorsky. I'm an independent financial planner and wealth advisor with Stratos Wealth Partners. I've been in this industry for about 17 years now, and I help my clients with different types of planning, whether it's retirement income, insurance, college savings, investment management, including stocks, bonds, and mutual funds, and then ongoing customer support and service, whether it's legacy planning or tax issues or estate planning issues that I'll work with other professionals. I do broker dealer through a company called LPL Financial, and their research department is the one that puts together this presentation for me twice a year. I will be recording this and it will be uploaded to my YouTube channel. So if you want to watch it again, or you have to leave for some reason, if you go to my website, which was up a minute ago at bryantSikorsky.com, and then click in the upper right-hand corner where I have my YouTube channel icon, and you can watch this again at your convenience. So with that, I'll dive right in and say that this mid-year 2020 report has our updated view on what we call the pillars of investing. And that includes the economy, the stock market, and the bond market. And we look at these pillars, and we also call them, you see the theme here is kind of like a hiking or a trail, taking to a trail or hiking in the mountains. We're looking at these trail markers to help provide perspective on facing these challenges now and preparing to move forward together. So at the midpoint of the year, we're mindful that it's been an extremely challenging year so far in the US and around the world. We're in the midst of a pandemic that continues to impact all of us, our communities, and our economies. Together, we're looking ahead for kind of new ways to face these challenges and how we can prepare now for better times. We've been, quite impressed by what we've seen so far with the resiliency and accelerated innovation amongst large and small U.S. businesses, efforts by our national, state, and local governments to support our communities, and most of all, the dedication and unprecedented cooperation among our frontline health professionals, medical researchers, and everyday people to guide us through this health crisis. And I'm sure that there's components there that haven't always gone as well as would have been hoped for, but I still think that we should feel good, at least for the good that has happened. And we'll talk about that a little bit more in just a moment. So we're going to take a closer look at the economy, the stock market, and the bond market. And then we'll take a look at the election and discuss and ponder whether the market can predict the next president. So let's begin with the economy. Much of the real-time economic data we follow, such as transportation activity, home sales, and jobless claims, are showing tangible evidence that economic activity, while still depressed, has started to make a comeback. The U.S. economy entered a recession in March of 2020 per the National Bureau of Economic Research as a result of the lockdowns and business closures to contain the COVID-19 pandemic. After GDP contracted by, and when I say GDP, I mean the gross domestic product, which is the measurement of all goods and services produced by the country, it contracted by 5% during the first quarter of 2020 on an annualized basis. And the Bloomberg consensus expectations for the second quarter are calling for a mind-boggling 34.5% contraction on an annualized basis, as this chart shows. So we see strong second half 2020 rebounding in economic growth as more of the economy opens up, and this recession may end up as one of the shortest ever. However, the resulting recovery is unlikely to be strong enough to get economic activity back to where it was in 2019 by the end of this year. So it's going to take a little longer than than I think we'd all hoped. The trajectory of economic rebound remains uncertain, but based on the depth of the contraction and the multi-stage recovery, our GDP forecast calls for a sizable contraction in 2020, as you can see here. Second half growth headwinds that may linger well into 2021 suggest as they call it, a swoosh-shaped recovery, or if you prefer, a check mark, a quick, sharp decline, and after a small snapback, a gradual recovery over the next 12 to 18 months. We believe the square root symbol, I've heard that one, I learned something new when I read about that, is too pessimistic because it implies a flat phase of recovery after the initial bounce, and a U-shape doesn't capture the multiple stages of recovery. So our characterization assumes a COVID-19 vaccine will not be widely available for as much as another year. So kind of think and put that one in your pocket for a minute, because you're going to see that mentioned a couple more times here. Verifiable progress on an earlier arrival could sustain the momentum of the initial rebound and move the economy closer to a V-shaped type recovery. So if we look at the stock market, we can see that stocks already are pricing in a steady economic recovery beyond 2020 that may be supportive if we receive breakthrough treatments to address the COVID-19 pandemic. So the optimism that we see reflected in the S&P 500 index now may limit the size of the gains over the rest of the year. So again, we're seeing that, the economy, some aspects of unemployment, et cetera, are looking good, but we have that, if you want to call it the elephant in the room of the COVID-19 pandemic. And again, we're going to see this mentioned again a little bit later. So our expectations for a gradual economic recovery in the second half of 2020 appear to be somewhat in conflict with the S&P 500's rapid ascent over the past 12 weeks from March to June. So on one hand, gains may appear appropriate based on the likelihood that the recession officially declared on June 8th may be the shortest ever, aided by the massive stimulus response by policymakers and hopeful initial progress, here we go again, toward a vaccine. On the other hand, the risk of a second wave of COVID-19 remains, particularly as some southern and western states have seen increases in infections and hospitalizations. In addition, some of the 20 million jobs lost in March and April, as reported by the U.S. Department of Labor, will take a while to come back due to social distancing constraints and the potential for lasting changes in consumer behavior. So the uncertainty around these paths suggests stocks may have come a bit too far and too fast. Although some recessions have seen stocks quickly recover bear market losses, such as in 1980 and 1990, most of the time the journeys back to record highs have taken a year or more. And if we look at, say, like October of 2007, we can see that duration was for 17 months, and it took 49 months, or about 4 years, to recover. So if we recover in just a couple of months, that's going to be something incredible. So I keep highlighting this COVID-19 treatment, cure, because again, it is the elephant in the room, if you will. But at the same time, I think most of us will have a difficult time comprehending how much effort was placed in trying to mitigate this recession through monetary policy. You saw the initial stimulus program. You saw potentially not having to be paid loans given out to small businesses. We saw a delay in having to file our tax returns. we are seeing another potential $2,500, whatever the number is, check coming out. We saw an extension of unemployment benefits. So, there was a lot that the White House and Congress did to try to mitigate this recession as fiercely as they possibly could. I was absolutely, honestly, quite shocked to see some of the things that they accomplished. So we're going to talk about that again in a minute too. So our S&P earnings forecast for 2020 is $120 to $125 per share. And the midpoint earnings would drop about 25% from 2019's level of $163, roughly in line with the average historical decline during recessions, as this chart shows. And this forecast reflects, number one, the severity of the decline in economic activity in March and early April. Two, the initial snapback in activity after many states began to reopen beginning in mid-April. And three, growth headwinds that will constrain the trajectory of the recovery later this year. So we believe the optimistic economic recovery scenario reflected currently in stocks may limit their, here we go, listen to this, limit their upside potential for the rest of the year. So our year-end target range for the S&P 500 is 3,250 to 3,300 based on a price to earnings ratio of slightly below 20 and a normalized earnings figure of $165, as you can see here. So what does all that mean? Holy cow. It means that stocks have become pricier. So, when you're buying a share of stock now, it's costing you more to share in that potential growth or those potential dividends down the road. And I'm going to share with you in just a second another thought, and that is, first I'm going to share this with you. An annual earnings run rate like this may not be achievable until 2021, but with interest rates so low, that was another one I meant to mention and I forgot. And the possibility, here we go again, of a COVID-19 vaccine, we're comfortable using a longer term earning target to value stocks here. So what does all that mean? What that means is that you're going to pay more for stocks, which means they're going to have an inherent less upside potential. So just be cognizant of that, number one. Number two is, let's think about, there was all of this monetary policy that the White House did and Congress did. But what's another reason why people would buy stocks, hypothetically, even at a time when they don't want to? Well, I can tell you, if today I was meeting with an individual, he's 81 years old. He had done all the right things. He had put together, he and his wife, a financial plan and a retirement plan and a retirement income plan. But guess what? His retirement income plan was put together 25 years ago. And it assumed that interest rates would never get lower than about 4%. So it assumed that he in his retirement and her in her retirement, the two of them, could take their money and get at least 4, maybe 5, kind of percent rate of return forever. And if they didn't withdraw more than that from their accounts, then their account would last forever. Well, this morning, this couple and myself, we scrambled around looking at everything from stocks, stock mutual funds, exchange traded funds, fixed annuities, fixed index annuities. We looked at all of these. And if you really talked about CDs, we talked about individual bonds, we talked about muni bonds. And any way you shake it, the kind of highest income yield that we could get was about 3%, maybe even 2-ish. So to get 3%, we had to invest over $250,000 and have the money held for 3 years. So think about that. You're only able to get, I'll tell you quite candidly, I just bought a house, I had a house built, and I closed on it, and my interest rate's like 2.85%. Who would have thunk it, right? So while that low rate is great for individuals and it might be great for industry, it's not so great if you're a retiree trying to, and if you are a risk averse individual and you had anticipated, investing your money in bonds, CDs, and fixed annuities, you're having to look at things that you don't really want to look at, possibly. So if I look at my research report, it tells me that our research department favors sectors such as communication services, healthcare, and still technology. And the reason being is because they offer the best combination of a strong balance sheet and relative earning stability for the challenging near-term environment and growth potential above and beyond the recession. So again, the prognosticators and the research folks are looking and making the assumption that the COVID-19 pandemic is going to be addressed sooner than later. And they're already opening up Christmas presents, maybe, like your kids would want at midnight. They even go so far as to say that if a true recovery resulting in another bull market were to occur, that we should then look at consumer discretionary investments, which makes sense. People have more money to spend, they're going to buy discretionary items. Financials and industrials. Again, financials leading into borrowing and investing and savings. In industrials, I just read where the administration is announcing their intent to put together a Restore America's Infrastructure program, which would play right into industrials. So we do have the opportunity for, reasonably good investment alternatives at the moment, but I'm being a tiny bit, not necessarily pessimistic, but just being a little bit realistic that all that can change on a dime if COVID really busts out of its gates. Right now, I don't want to say it's controlled, but it is mitigated to some extent, and we don't have the anticipated death count and mortality rate like we were seeing earlier this year, but we're not out of the woods yet. So this is causing investors to look at mutual funds instead of individual stocks, because mutual fund managers could possibly buy and sell securities to help mitigate volatility. They're looking at structured products, which are products that guarantee no loss of principal in exchange for a cap on their upside earnings. And we're seeing a huge drove of investors evaluating and purchasing annuities, whether they're fixed, some of the newer fixed indexed, or variables with some kind of a rider on them, either protecting principal or providing a lifetime income stream. So, the people are looking for and are willing to pay, if you will, a little bit more for what an exchange traded fund or a mutual fund or even annuity will charge you in order to have that sense of security. So if we look to the bond market, we expect rates to stay just about where they are. And these are historically low levels. I think the week that I closed on my house, the newspaper said that we had hit a point. It was 2.85 for 15-year, 3.15 for 30-year. That was fundamentally the lowest mortgage interest rate in history. And it was with 3% down, I think is what the numbers are saying. So we expect interest rates in historically low levels, which is great if you want to go and buy a new car and pump up those consumer discretionary stocks. year-end case scenario forecast for the 10-year U.S. Treasury yield is 1 to 1.5%. So think about this. To make yourself safe, you invest in treasuries, and you're gonna lock that money up for 10 years, and you're gonna get 1%, maybe 1.5%. And these would be the lowest levels for a year to end on record if this actually does occur, which I think it will. I'm also getting in the mail now these zero interest rate credit cards. Transfer your credit card balance to us and we won't charge you any interest for 18 months. Holy cow, right? So something just to think about. The rising treasury yields contribute to bond prices falling, which can be offset by credit spread tightening and the interest income that most bonds provide. And as this chart shows, with the credit spread for the Bloomberg Barclays aggregate bond index already near the average for the last cycle and interest income at historically low levels, we would expect the index's return to be near flat over the rest of 2020, and with even some risk of small losses. So we're already down at 1%, and yet they're saying that that could go lower. And if that did go lower, then the principal value of our bonds would actually go down. Not a lot, but a little bit. So think about that. You're earning 1 to 1.5%, and you might experience a loss on top of it. So the Fed is unlikely to hike or cut rates in 2020, and possibly not in 2021, even if the economy recovers and if that recover is a little better than our baseline expectations. Persistently low inflation during the last expansion should minimize any Fed concerns that it needs to raise rates preemptively to keep inflation under control. Consistent with its messaging, we expect the Fed to remain accommodative for some time, and raising rates probably won't be on the table until after it ends its bond purchase program known as quantitative easing. Now, the Fed did not start raising rates in the last economic cycle until more than a year after its final round of bond purchases. So there's all sorts of factors that are saying that we should expect interest rates to stay where they are for a year or more, which is incredible. So where can we, if we're looking to buy some bonds or invest in bonds, where can we get a little bit of yield, for heaven's sakes? Well, we do have at my research department, they do have a searching for income kind of booklet for me, and they give you different ideas ranging on your risk tolerance, whether you're risk averse, moderate income, maximum income, or you're even willing to put a little bit of stock capital in your retirement income. So with that, they are advocating stocks that are that are near benchmark credit quality. So they're concerned about, some investors are investing in junk bonds or low credit rating fixed income just to get some yield, just to get some income. So they favor mortgage-backed securities for their combination of interest income and limited rate sensitivity. Remember, we're talking about what if rates actually go down? Well, if rates go down, then principal on fixed income can be harmed. So that's why they're saying, let's look at something with limited rate sensitivity. They are neutral on investment grade corporate bonds with valuations only slightly attractive and leverage increasing, but they do still see incremental value for corporate bonds as opposed to treasuries. And they actually prefer stocks to credit sensitive bond sectors. So of the sectors they're looking at and recommending dollar denominated emerging market debt, so small company foreign debt, and high yield bonds. Not completely into the junk bond category, but we want to get a little bit of yield. It might make sense to spice the portfolio a little bit with some less than perfect credit quality bonds. Municipal bond yields are attractive relative to treasuries and to tax sensitive, and for tax sensitive investors. So we still maintain a bias towards quality and are more cautious on the extreme high yields. I think I was looking yesterday at, we've got a couple of mutual fund companies like MFS, I know, has a North Carolina municipal bond fund, which I think is yielding about 2.5%. And it is both federal and state tax-free, so something to look at. Our next and final section is on the election. Although all election years feel different, 2020 no doubt may be one of the most unique election years ever. That's probably an understatement. We have an ongoing pandemic, a deep recession, incredibly heightened partisanship, a mail-in ballot controversy, a bit of an unpredictable president, and a bit of the oldest presidential candidate, who I guess with some of his meetings has been a bit unpredictable himself. So what does that mean? Well, what it tells us, we're often asked if stocks perform better under a Republican or Democrat president. And we take a different angle and point out that stocks have tended to do their best. Might be surprising, when we've had a split Congress. Why is that? Well, markets tend to like checks and balances to make sure one party doesn't have too much sway. So when the Republicans have controlled both chambers, on average, the S&P has gained 13.4% and GDP has grown 3%. When the Democrats have controlled both the House of Representatives and the Senate, the economy did a little better with a GDP growth of 3.3, while the S&P was up 10.7. While we've had a split Congress, however, the S&P 500 has gained 17.2 and GDP growth is 2.8. So again, suggesting that markets may prefer a split power when November comes, as this chart shows. So how stocks perform the 3 months ahead of the election has delivered a solid track record of deciding who will be in the White House the next January. The S&P 500 has predicted every presidential election winner since 1984 and 87 of the winners since 1928, with stocks favoring the incumbent party if stocks are higher in the 3-month period before election. As the chart shows, if stocks sell off ahead of the election, the opposition party has tended to win and the incumbent party has lost. So I guess that tells us why right now, August, September, and October are going to be those keynote periods. And I think a number of people are kind of thinking ahead too, what's it going to be like if A or B or C gets elected? So why are markets so volatile ahead of elections? And that's because of uncertainty around policy changes. In the election, in this election, the states are particularly high for corporate America because a takeover of the Senate by Democrats and a possible Biden victory may lead to an increase in the corporate tax rate from 21 to 28% and an unwinding of the corporate earnings boost that the 2017 Tax Cut and Jobs Act delivered. So, a takeover of Senate and a White House controlled by Democrats could really have a significant impact on the market, particularly because of the rising tax rate on companies. On top of that, financial regulation could tighten and potentially impact markets. I read recently that Elizabeth Warren is allegedly still in the mix as a vice presidential candidate, and she has always espoused a very strong control and higher taxation of banks and savings institutions. Healthcare could perform very well regardless of the election outcome, with Medicare for all off the table and a pressure to reduce drug prices, which is a bipartisan effort. And finally, energy could be hurt by a Democratic sweep, but prices may get support from lower production and higher production costs. And this whole green energy initiative is really a mixed bag that nobody's been able to quantify quite yet, meaning, investment in that would be almost like, an infrastructure improvement, but at the same time, what does that do to fossil fuels? So, as I've said about 6 or 8 times here, the path of the economy and markets in the second half of 2020 will depend upon, or may depend upon, it says, how much progress we make against COVID-19. If recent evidence of potential economic recovery is a prelude of things to come, which I think the market is already anticipating, and stocks are accurately assessing a favorable growth outlook, then stocks will rally to new highs in the second half. Alternatively, in the event of a second wave of infections and renewed and reimposed lockdowns, the economic recovery says may stall. I'm telling you, it will stall, and stocks may be ripe for a correction, which I will tell you will happen following the strong gains off of the March lows. When uncertainty is high and markets are volatile, staying the course and focusing on the long term can be difficult, and we would continue to view bouts of volatility as opportunities where suitable to rebalance your portfolios towards longer term allocations. So the COVID-19 crisis has been one of the toughest we'll ever face, but by facing these challenges together and with many heroes at our side, taking advantage of opportunities in the markets and focusing more on the long-term objectives rather than becoming fixated on the bumps along the way, we can make decisions that put us in a better position to seek out our long-term goals. So I'm measuredly, optimistic, but I'm still, in the back of my mind, I'm thinking about, COVID. And when I'm working with clients, I had a client today who wanted to, move out of a moderate portfolio that's done really well for him, but hasn't done quite as well as his neighbors, because his neighbors investing aggressively. And I'm trying to talk him off the ledge of saying, don't deviate from your true risk tolerance, because if that correction comes, it'll come hard, just like it did in March. So with that, I would say thank you very, very much for being with me this evening. If you have any questions or if you'd like to set up an appointment on the phone or via Zoom, here's my website, BryantSikorsky.com. All of my contact information is here, my phone, email, and up here in the upper right-hand corner, you can see my Facebook, LinkedIn, Twitter, or YouTube channels. And what I'm going to do is I'm recording this, and I will upload it probably some tomorrow to my YouTube channel. You'll be able to click on it, and you'll click on videos, and you'll be able to see all the different YouTube webinars that I've given that you can review on different topics. So with that, I'll say thank you very much. Thank you for joining me this evening. Again, my name is Bryant Sikorsky. I'm a wealth advisor with Stratos Wealth Partners, and I hope you have a great rest of your evening. Thanks.